Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, March 31st, end of the month, end of Q1, with Shaun Burgess, Bond Portfolio Manager and Analyst here at Cumberland. You know Shaun, we chat when John is on the road, right? Okay, what did we see this quarter? I'll tell you what, this was the hardest up 6% S&P, up 20% NASDAQ 100 quarter that I can recall, right? If you look back at a quarter and the S&P was up 6% and the NASDAQ was up 100, you felt like you were just sitting in your seat. Boom.
Yeah.
But you had a ton of volatility. You had headline news both internationally, domestically. You had banks teetering. You had a number of different scenarios that almost forced you to keep one hand defensively and in the defensive camp, you know, and that's probably reasonable.
Yeah, all that volatility really helped dampen some of the enthusiasm that you typically have with the performance you've had in the equity markets.
Yeah.
You really had to act defensively in here, as you said. So,
and probably
a little rougher quarter than it should have been otherwise.
Yeah, the peak of some of that fear, I think, Shaun, we saw 2 weeks ago. Talk about the comparison in Treasury yields and Treasury action from 2 weeks ago. Keep in mind, when we see inflows into Treasuries at the extent we saw 2 weeks ago, that is fear. Talk about what we've seen the last couple of weeks.
Yeah, I mean, we put up that graph last Friday of the intraday move in terms of yield on the 2, the 5, the 10, and the 30. That's a great graph. You know, and it really showed how much volatility you had intraday, how large those moves were. And you don't see those in Treasuries very often. You know, that's a multi-decade move. And it was really off those banks. And you know it's fear because nothing else really participates in that upside as much as Treasuries do.
Right.
You had other fixed income go a little lower in yield, higher in price. Munis, you know, were along for the ride, but they didn't perform like Treasuries did. And you know, it really culminated 2 weeks ago, and we've seen it kind of peter out as the banking situation has kind of found some stability in here, and the Fed really came out and said they're not worried about the banking sector so much. They're still continuing to be worried about inflation, and that's where their focus is.
Right, and I think we'll continue to see ebbs and flows of headaches within the banking and financial sphere. As a matter of fact, in Q1, the only two places where you couldn't make money were in the financials and energy, right? Energy was a big winner last year, a little reversion to the mean. Banking, trying to get its feet under it. Both banks, financials, insurance companies, anything tied to the bond market, anything tied to inflows and outflows of deposits, right? Funny that going back to showing that chart of that intraday volatility in Treasuries. Remember, Treasuries are vanilla pudding for us normally. 2 years, 5 years. So when Shaun's talking about that kind of trading activity, we really have to pay attention. What was interesting is Leo Chen, Dr. Chen, who does our quant work for us.
Great work.
Had his first buy signal in the quant strategies on March 10th, which was a Friday, so we actually bought on Monday. And for the first time that I can remember, and Leo did some work on it and couldn't find another period going all the way back to 2008, Shaun, he had 10 buy signals in the next 11 sessions. You know, that's fear.
That's fear. That is explicit fear.
And if you look at the futures market, and let's go back to a year ago when I used to talk about the small speculator. We have nothing against small traders, but we like to know how they're positioned. A week ago, in the futures market, the small speculator, and small meaning the amount of contracts in the options market or futures that are owned, was the highest percentage of short positioning that we've seen in the last 12 months, but similar to what we saw all the way back in 08, 09. So that was during the bank crisis, which, listen, that bank crisis is not over. We're still going to see ripples from that. So we'll still see volatility. But we did get that real peak fear we'll see what happens going forward. Couple quick notes this week, trade-wise. Earlier this week, we did in U.S. ETF, which concentrates an awful lot on industries and sectors. We added semiconductors. We added more to our healthcare. And we added to some QQQ. That may have been the end of last week.
Yep.
Over in U.S. Core, which tries to get the broad strokes right, we added to our S&P 500 midweek. It came down, made a little bottom there. We added. We'll see what happens. Internationally, we added to our international value. So we did some buying this week. We'll see how that continues through the first week of April.
It's been good timing so far.
So
those
far.
trades, having that cash.
Having to,
We talked about it. It really helps, especially as you get these opportunities.
Yeah.
And how many times have we said, this is an event we haven't seen in decades? We've said that a couple of times this year.
Right.
Now.
It's like the 100-year flood that you see every 4 years, right? In terms of the markets.
Great opportunities. So.
Quick note: we really thank you for the time you take to watch our video every week, and some of you that read our commentary. We have a link below. It's a short survey. It'll take you 2 minutes. We'd love to hear what you'd like to see us talk about. Are we hitting on the things that make sense in your game plan from a trading standpoint, from an investing standpoint? Client-wise, are we giving you enough transparency into what we're thinking in the markets? If you can take a couple minutes to fill out that survey, we'd sure appreciate it. Have a great weekend. We'll see you next week.